Hey everyone, and welcome to the channel. So what's next? Continuation of the downtrend or a sophisticated trap before the next wave of selling? So yesterday's target has been met, sell side liquidity has been taken, and this is precisely where the market gets interesting. The average retail trader will now see this as a bottoming process and a buying opportunity. But this is exactly the assumption that fuels the next sophisticated maneuver. Was that the end of the markdown or merely the calm before the next storm? We are now at a critical inflection point, and smart money has two primary plays available. One of them is a particularly deceptive setup. Scenario A, the bearish continuation. This is the straightforward path. The operators continue to apply pressure, driving price discovery to the downside without a significant retracement, targeting the next major pool of sell-side liquidity. Scenario B, the smart money trap. This, in my professional opinion, is the higher probability play. The composite operator will engineer a corrective rally, a retracement back into a premium zone, like the fair value gap around $4,640 to $4,660. The objective? To induce longs from retail traders who believe the bottom is in and to liquidate early shorts. This manufactures fresh buy-side liquidity, which they can then use to fuel the next more aggressive leg down after adding to their short inventory at a more favorable price. All right, let's take a deeper dive. Based on a comprehensive analysis of charts through the lens of the smart money concept, here is a breakdown. The market structure for Ethereum is decisively bearish. The recent sharp decline was not a random event, but a confirmed institutional markdown characterized by aggressive selling and the inducement of long liquidations. The current price action is a corrective retracement, likely engineering liquidity before the next major leg to the downside. The primary objective for smart money is to reprice the asset lower to attack sell-side liquidity pools below the recent lows. High time frame context, the bearish shift. Break of structure. The aggressive down move on September 15th resulted in a clear break of structure to the downside. This violated the previous swing lows, confirming a shift in market control from buyers to sellers. The order flow is now unequivocally bearish. Distribution confirmed. The price action at the peak, followed by this markdown, confirms a successful distribution campaign. Smart money has offloaded their long inventory and is now actively positioning short. Open interest. The most critical piece of evidence is the sharp rise in OI coinciding with the price drop. This indicates that new capital was aggressively entering the market to initiate short positions, validating the institutional selling pressure. Cumulative volume delta. The CVD shows a steep, sustained decline, confirming that the move was driven by aggressive market sell orders, not just a lack of buyers. Volume profile. The price is now trading significantly below the main high volume node located around $4,550. This area represents a former zone of balance that has now been decisively rejected. This level now acts as a formidable resistance and a premium supply zone. So where is smart money driving the price? Their campaign has two phases remaining: engineering liquidity and continuing the markdown. Phase 1, engineering. Liquidity. The current retracement is a classic maneuver to engineer buy-side liquidity. By allowing the price to drift up, it achieves three objectives. It stops out early, impatient short sellers. It induces bottom fishing retail traders to go long, creating a pool of buy-side liquidity. It allows smart money to mitigate their initial short entries and add to their positions at a more favorable price within the supply zone. Phase 2, markdown continuation. Once sufficient liquidity is engineered, The next wave of aggressive selling is expected to begin. So, what is the most probable forward-looking scenario? The current corrective bounce will likely continue towards the key supply zone and former value area between $4,550 and $4,600. This area represents a premium price to sell. We should anticipate price to stall in this zone. Upon seeing signs of absorption and a resumption of aggressive selling on the LTF, the next major leg down will commence. The primary target is the sell side liquidity resting below the September 15th lows. A move to test the lower value area around $4,300 is a logical and high probability objective. The path of least resistance is down. The current rally is a low quality bounce and should be viewed as a retracement into a premium shorting opportunity. The institutional order flow is bearish, and their objective is to seek and destroy liquidity at lower prices.